hardest, followed by technology. Communication services, good lesson there. The primary reason for that was Meta, formerly Facebook. And I think that many people who have felt very comfortable with the FANGs and it looks, when I look at large cap growth portfolios, they have the FANGs and Microsoft and Nvidia and now Tesla, many of them. Happy about that. But, some of the disruptors, like the FANGs, are now being disrupted. TikTok is taking mind share, the consumer's attention, away from Netflix and from Facebook and other social networks. So that's a lesson, and we're always on our toes. We do not own the FANGs, as you know. While tech was hit almost 10% in the quarter, non-indexed tech, meaning tech not in the broad-based benchmarks, was hit even more. And I think one of the things that started last quarter was an asset allocation shift at the margin from bonds into equities. Now, bonds had their worst start to a year in the first quarter since 1973. And so I'm sure a lot of people are asking the question, wait a minute, is this 40-year bull market in bonds when interest rates went down from at their peak on the long-term treasury around 15% to the trough 0.5% in the coronavirus, now at 2.3, 2.4%, is the bull market over? We don't think, when you get close to zero, it's got to be almost over. So we don't think bonds are going to deliver anything like the returns they've delivered over the last 40 years. But we don't think they're going to be a killer either. Especially if we're right that the deflationary forces associated with innovation are going to become pretty powerful. And if we're right on inventories and the cyclical forces turn down as well, then bonds are probably going to be okay. But nonetheless, the question and the shift towards equities, especially if they're underweight equities relative to bonds in their own asset allocation models, but they won't allocate to the truly disruptive innovators who are not in indexes. In fact, in many firms, you'll find that the analysts are focused only on benchmark stocks. That's what they're measured against. So that could be a little bit of what's going on. Today, very importantly, with the employment report, the yield curve, 2s to 10s, as I started talking about earlier, inverted. And again, that's a warning to the Fed. At 2.35% on the 10-year Treasury bond, which tends to track nominal GDP growth over time. So 2.3, 2.4%, that is telling the Fed, the bond market actually is telling the Fed, look, we think growth and inflation are going to be lower than expected, so be careful. We've been amused over the last, I would say it's maybe 2 months, that once the 2s to 10s started to invert, there was a shift by people who just wanted to be bullish on activity and growth and value stocks, a shift to the 3-month versus 10-year. Well, we've studied that, and the 2s to 10s, so that yield curve, is a leading indicator for the 3-month to 10-year Treasury yield curve. So I don't know why everyone took that jog at the same time. It was, as I said, amusing, but just know, at least from our point of view and from our research, the one that we place a higher priority on or place more weight on is the 2s to 10s. It's inverted. And in post-World War II experience, every time the yield curve has inverted within 12 months to 18 months, we have been in a recession. So that's consistent with the inventory and output dynamic I described a little earlier. The other thing that's a bit of a warning here, our spreads are opening up. And what that means is corporate yields relative to Treasury yields are starting to move up. And that's another indicator that bond investors are worried about the fundamentals of corporations, which of course are impacted importantly by the economy. We've seen an asset allocation shift towards crypto, towards gold. Crypto was fairly flat, as measured by Bitcoin at least, in the first quarter. Gold was up 7 to 8%. So both of those much better than both equities and bonds. And the dollar there, that was also up 3 to 4% in the first quarter. We're seeing the dollar continuing to move up against the expectations of the bears out there who believe that the twin deficit, so the federal budget deficit and the trade deficit, are going to cause an implosion in the dollar. The dollar is moving up, and I do believe there's a terms of trade reason for it. China's become more hostile to capital. Europe's in recession and on the border of a war. And the U.S. just seems like a safer place to be right now. And I'll end right now by just finishing up where I started. Disruptive innovation is inherently controversial, and the strategies focused on disruptive innovation are volatile, to be sure. And I just want to recount a little bit from my career and focused on disruptive innovation. Let's take Amazon, for example. Where I was in the business at the time, we bought it close to, it's going public. And I remember during the tech and telecom bust, it did come down dramatically. And the reason it did is because investors wanted their companies to be profitable, and Amazon was investing aggressively to capitalize on one of the biggest retail opportunities in history. And most investors couldn't see that, which was surprising to those of us who focus on disruptive innovation. And I can't tell you how many times the sell side and the buy side said, this thing's going bankrupt. This was a figment of Jeff Bezos's imagination, of Wall Street's imagination. And now we have a $1.6 trillion economy. The same with Apple. Nobody thought Apple could win against Nokia, Motorola, Ericsson. How could they? Apple had no share. They had all the share. How could this be? Well, Apple redefined the cell phone into a smartphone, a computer in our pocket. And now we have nearly a $3 trillion company. Bitcoin, when we first gained exposure to Bitcoin in 2015, many observers basically dismissed it as, well, that's a marketing gimmick from this new firm that's trying to find its way onto the map. And of course, I think that was at a $6 billion market cap or network value. Today, it's nearly $1 trillion. That was 2015 to now, 7 years. It's $1 trillion, from 6 billion to $1 trillion. And remember, people were calling it a Ponzi scheme. We had to suffer the arrows associated with that kind of criticism. And even Tesla more recently, 2019, Tesla was not going to be able to scale its manufacturing. It was going to run out of money. The large auto manufacturers were going to run circles around it. And what do you know? It's up 20-fold since then, $1 trillion company as well. So, and the other thing I'd like to note about disruptive innovation is that if you own the NASDAQ 100, don't think you own disruptive innovation. In the day, the NASDAQ 100 was really embraced disruptive innovation. Today, you'll find you own the FANGs, which you own in most other portfolios, and Microsoft, maybe NVIDIA. And then if you look a little more closely, you'll see that you also own some brick and mortar retail, trucker, rail, utility, names that, food companies, lots of them, I think, names that we'd never have found in the original NASDAQ 100. At least if they were there, they were de minimis. And then if you look into the rest of the NASDAQ 100, you will see companies that we will believe will be disrupted. Now, are there disruptive innovators in the NASDAQ 100? Yes. If you look across all of our strategies and look at the NASDAQ 100, those truly disruptive companies comprise roughly 25% of that index. So disruptive innovation is inexorable. These are flywheels, we believe. The 5 innovation platforms: genomic sequencing, adaptive robotics, energy storage, artificial intelligence, blockchain technology. They've hit escape velocity, all of them. There are 14 different technologies involved in all of them, and they are converging. So we think there are explosive growth opportunities out there. So don't give up. Keep your focus on the long term. Keep your eye on the prize, and I think it's going to be a very exciting future. Thank you so much.